Good evening, folks. How are you doing? Hope you're here to ask some questions as per usual. Good evening, Yuvan. Good evening, Ande. UGN 500. How's it, people? Sure, what a day, what a day, what a day. Don't know about you guys, but I have been pretty busy today. Swept live to view real-time performance. Oh, okay, whatever that means. Anywho, as you know, this is the live TikTok, and yes, I've changed it from a Tuesday evening to a Wednesday evening. I just find it works out better for me if I organize my week like that. So folks, you're welcome to jump in and start asking questions, and let's see what I can and cannot answer for you. Let me just sort out this. I hope that's better. Okay. I hope to see Esty here for tonight because she says that she's been wanting to ask me questions on live. So let's see. What else there? Invite another. I'm not going to invite anybody else. We'll just see what happens here. What's that? Mirror, mute, pause, settings, comment about me. Oh, okay. Okay. Whatever. How's it, Nasif? Good evening, sir. Hi, Cabello. Welcome. Juklu, welcome to you. See, we've got a number of people on here already, so let's get going. What can I tell you? Good evening, Dealmaker. Hi, Tando. How's it? I don't know where you guys are in the world, but we are in Krugersdorp, and this afternoon we had, in Afrikaans they call it the wolkbreek. And gee, we had a storm of note. The lightning took out the power, took out the Wi-Fi, took out everything. As a matter of fact, for a while, I didn't even think that we're going to have this tonight. Tando, I'm good. Thank you very much. So yeah, folks, it has now calmed down, but it is nice and cool. Nasif, are you in Rudderport? Well, fantastic. So we're close to each other, mate. It has now calmed down a bit, and yeah, at least we can do this tonight. So let's see, is there anything? So far, I'm seeing a lot of people joining. No questions yet, no comments yet. So while I'm waiting for the first person to put a comment in, I want to try and explain something quickly with regards to risk. Okay, Dealmaker, let's see what we can do. I want to just explain something with regards to risk. And I should have thought this through before I started here tonight. But if we take a piece of paper like this, okay, and we say that this piece of paper represents the risk spectrum. So if you start on this side, you're very conservative. On this side, you're very aggressive. So people that should be conservatively invested, meaning on this side of the paper, is people that are, by nature, people that are very safe, people that are pretty old and want to protect their pension fund monies, people that wants to have a guarantee in life. That's the type of people. But if you are somebody that wants to take a bit of risk, that wants to invest your money and make sure that it's going to grow properly, that wants to see proper growth on your investment, you should start investing here from the middle to this side. So from the medium side to the aggressive side. And from the medium side to the aggressive side, there is plenty of investments that you can do that, even though it is aggressive, is actually pretty low risk because of the diversification in the fund. And my opinion is, if you look at risk, guaranteed interest that you get at a bank, that is the lowest risk. Then you get stable and income funds, that's a little bit higher. Then you get medium risk funds and stable funds and balanced funds. Those are the things that are in the middle, and that I would still not recommend to a lot of people unless they've got less than 5 years. Then you get to something like an equity fund or global equity fund, and those are your aggressive funds. And then you start moving to things like arbitrage and alternative investments and venture capital, and then you go into the more risky stuff. So if people understand that, that's the first part about understanding risk. The second part about understanding risk is if you understand that the longer your investment term is, the more risk you can take. And you understand that even if there is a downturn in the market, you must just stay in your investment. The investment will recover and you will get your money at the end of the day. You will get your good growth at the end of the day. Then you have already, when it comes to investments, you've already crossed a very big barrier in terms of understanding investments. So I want to just mention that. If you are an investor with a short investment period of time, 1 year to 3 years, maybe 4 years, you will be looking at conservative investments. If you are an investment that's got 3 years to 6, 7 years, maybe even less, 5 years, you can go into medium risk. But if you're an investor with 5 years or longer on your investment spectrum, you should be invested aggressively. And this is the one thing, people that goes on pension, they normally think that they are conservative investors and that they have to protect your capital. Not so. If you retire at the age of 60 and let's say you're going to live to the age of 85, and that's very possible these days, you've got 25 years left of investment terms. So because you've got such a long spectrum, you can still be an aggressive investor and still be comfortable. Okay, that was just that quickly. Let's start and see what we've got so far. Can a Muslim person invest while not receiving interest because we don't believe in interest? Yes, Salusi, Muslim people can invest. As a matter of fact, there is a number of portfolios that is specifically aimed at Muslim investors that does not take interest, that does not invest in any alcohol or tobacco or other products that Muslim people do not believe in. So yes, there are indeed investment products and portfolios for Muslim people. Hello, if Ali says, if I invest 1.4 million in bank, can I use the 148k interest as my tax concession? I'm over 65. No, Ali, you can't. So here's the thing, Ali. What's the amount? Let me just double check here, because you say you are 65. So for somebody that is 65 or older, the interest exemption, and I think it's changed this year, but the interest exemption was 34,500 Rand. So your first 44,500 of this 148,000 interest will be tax-free. The difference, so that's about 114,000, is taxable. Now, if this is your only income, it is very possible that you don't have to pay tax on it because of the tax tables. Because a person earning about 110,000 Rand with the rebates that's built in that they can get from SARS, they actually will not pay tax. So yes, they on the 18% tax rate. So strictly speaking, they should be paying 18 or 20,000 Rand tax per year. But then when you take off those rebates, the primary, secondary, and tertiary rebate, then that actually takes away all of that tax thing. So I hope I make it clear to you is that you do not get a tax concession on the 148,000 Rand. You get a tax concession only on the 34,500. But if you have no other income, and this is your only income, then because of the rebates that you can get, you won't pay tax. Okay, Ali, I hope it answers that one for you, mate. I would like to get to know investments which are a bit higher than the bank. Dealmaker, there are in South Africa alone more than 2,000 unit trusts that you can invest in. And those 2,000 unit trusts, I would say most probably 1,900 of them are already a higher risk than what a bank savings account is and will give you a better return on investment. Then there's portfolios that you can make use of if you're going to do an endowment. Same story. Plenty of portfolios that you can make use of. Then there is the arbitrage that I spoke about, alternative investments, etc., that you can also. So there is so much. The problem is actually not finding an investment that is higher risk than the bank and gives you higher returns than the bank. The problem is picking the one that you will enjoy and that you want. And this is the biggest problem, deal maker, is everybody always wants to have the best portfolio. So when I get people to talk to me about investments, they say, what is the best investment moment? Which is the best portfolio? I can't tell you because I don't know which of the 2,000 portfolios is going to do the best this year. But I can tell you that I can put you in a portfolio where I can be certain that I'm going to give you good growth. That means, that was weird. That means I can actually put you into an investment where I know that you are going to earn a growth rate that's going to be anything between 3 and 7% higher than inflation. And that's the idea with investment. The investment thing in the world is you're not supposed to get the best growth every year. You're supposed to get good growth every year. And then over time, because you get a lot of good growth over time, you then beat inflation and you become wealthy, okay, because of the compound growth effect. Investments is not interest as long as you invest in the right vehicle. That's correct, Nassif. You're 100% there. Janelle Singleton. Hi, correct. It's William. Oh, okay. It's not Janelle, it's William. Hoe werk belasting as jy spaarrekening by bank het? Insit wat jy wil. Okay, so Janelle, William, ons het pas daarvan gepraat, maar ek sal gou weer vir jou sê, as jy 'n belegging het, and William, I'm going to change to English. I realized last week I answered the question of Afrikaans. It took a few minutes and I lost half the crowd because unfortunately most people speak English. So I'm going to keep to English. So in terms of interest for a savings account at the bank, if you earn interest of more than 23,800 Rand and you are under the age of 65, okay? In every Rand over that 23,800 Rand attracts tax. So what I do and what I normally advise people is I say, listen, look at investing about 300,000 Rand in the bank. 300,000 Rand should be enough for you as an emergency fund. And irrespective of what the interest rate is that you're going to get in the bank, you're most probably just going to get to that 23,000 Rand level, a little bit above or a little bit below. So you can have an investment that's going to give you interest where you've got emergency fund money and that you're not going to pay tax on. But for the rest of your investments, put it somewhere else. Don't put it in the bank. That's my honest opinion. I just want to ask, what's bond layering method? Okay, here we go again. TK, I see I get this question a lot these days, the bond layering thing. So bond layering is basically the following. You can go and buy government bonds, and you can buy government bonds on different terms. 1 year, 2 years, 5 years, 10 years, 16 years, it doesn't matter. So bond layering basically means that, let's say you've got 100,000 Rand. And you're going to go and you buy yourself a 5-year bond. Then you take the next 10,000 Rand, you buy yourself a 6-year bond. Then the next 10,000 Rand is a 7-year bond. The next one is an 8-year bond. And so you get yourself bonds that you are going to have a bond for a specific period of time that's going to pay out after that time. And then every year another bond is going to pay out. And that is what layering is. But like I explained to somebody yesterday, I would not do bond layering. I don't care what anybody says. Because you're earning interest. A bond is interest that you're getting paid. And once again, it's the same as bank interest. So you are going to pay tax on it. So you earn, let's say you have a bond of 10%. And you get your 10% return on investment. After tax, you walk away 7.5 or 8%. So when I just started in the industry, late 80s, 90s, a lot of financial advisors did similar to bond layering. They did endowment layering, I could call it. So they would sell a client an endowment and then another one, and everyone matures. And so every year you've got some money paying out to you. These days, the investments has been made so flexible and it is actually to your benefit to just have one investment. It's easier to administrate. It's less headaches. You can withdraw what you want. You can put in what you want. You can put in 10 different portfolios. So you can actually go and create your own layering within the investment. So I would not do bond layering. As a matter of fact, I don't even do endowment layering for clients anymore. I just do an investment for a client that suits their situation, and I put the portfolios in that's going to be most beneficial to them. and then we run with it for as long as necessary. I hope I've explained the bond layering. Honest TK, don't waste your money on something like this. You can sell a bond earlier, I know, but then you're not going to get the return that you wanted to get in any case. Invite the Jewel Show to Coast. Wonderful. Stan Simmons just followed to Nasib. So Lucy says, the thing is, I want to buy a car and then talk about interest. As a Muslim, I want nothing to do. Buy a car and they talk about interest as a Muslim. Oh, I see what you're saying. The thing is, I want to buy a car and they talk about interest. As a Muslim, I want nothing to do. Okay, so here's the thing. Unfortunately, when you invest money as a Muslim, you can choose to be invested in a fund that does not have interest. But when you go and buy a car, they don't care whether you're Muslim, Christian, Jehovah, whatever the case might be. The person selling you the car, the company selling you the car, they want to earn the interest. That's why they are doing it on a lease agreement basis. Because if they sell you a car cash and contant today, they're going to ask you 100,000 Rand, they're going to make this little bit of profit. But if they sell you that same 100,000 Rand car and they can lease it out to you, then they can charge you interest because they're lending the money to you. So now they're not making 100,000 Rand out of the deal. Now they're making 120,000 Rand out of the deal. So as much as you don't want to talk about interest when you buy a car as a Muslim, they're just not going to care about it, mate. I don't know if there is maybe Muslim car dealerships that you can go to and buy it in that fashion. But that's about the only place you're going to get away with it. Okay, so that was that. Okay, oopsie, sorry, it's jumped again. Every now and again this happens and then I have to go and find my spot again. Sorry, folks. Gee whiz, I've now jumped far forward. Okay, there we go. Let's see. Let's try and keep it there. How to negotiate 1/3, which is higher during retirement, and how can you negotiate? You can't negotiate the 1/3, Rendani. The 1/3 is 1/3. So if your pension fund money is 3 million Rand, the 1/3 is 1 million Rand. All you can do is you can say, okay, I don't want the full 1 million Rand. I only want 500,000 Rand. And the other 500,000 Rand must go with the other 2 million, the 2/3 that I have, and that can give me a higher income. But you cannot negotiate the 1/3. That is pension fund, provident fund, and retirement annuity rules. That when you get to retirement, you can take 1/3 in cash. Option is you can, you don't have to. And the other 2/3 must give you an income. But there's no negotiation. The only thing you can negotiate is to say, okay, I'm not going to take the full 1/3. I'm going to take nothing, or I'm going to take less because I want a bigger pension. So that's where the planning comes in, because there's taxes that's involved. And once the tax calculations has been done together with the actual income calculations, then only can one see what is going to be the best. I've had clients often that said, listen, I don't want to take the 1/3 because I don't only want the 550,000 tax free. So I'm not going to take the 1/3, or I'll have to take a bigger income. And then when we do the calculations to see what the tax is going to be on the income versus taking 1/3, paying that tax there, taking the income from the 2/3, paying that tax there, and then reinvesting the 1/3 in order to give me a supplementary income, we found in a lot of cases that it's better to actually then take the 1/3 and reinvest that money and then supplement your income. But it's a calculation. It works different from person to person and amount to amount. And I can't even say to you, listen here, it's better for lower amounts or higher amounts. Bottom line is, you can't negotiate it. Planning to invest 1.3 million for 6 months with a bank. No, Cabela, I don't think it's a good idea. Like I just said, if you want to invest money with a bank, 300,000 Rand, that is my benchmark. 300,000 Rand, that's what you put in there. That's an emergency fund. It gives you interest, but the interest is not taxable. The other million Rand, go and put it into a different investment where you're going to outperform the bank by 2, 3, 4, 5%. So no, I really don't think it's a good idea, Cabello. Find a different investment. Contact us. You've got my contact detail in the profile, so contact me and I'll give you a couple of ideas. On which side of the investment would you recommend, would you regard SA retail bond deal maker? If you've just listened to me on what I said about retail bonds, I don't like bonds, so I would put them on the bad conservative side of investments. Bye, Donkey Nassif. A guest. Okay, 100%. Let's see what's next. Good evening. A very respected circle and his guest might be with you. Oh, okay. Don't know. Good evening. A very respected Sir Corny and his guest may be with you. I don't know what you mean by that because I don't even know how to include guests, to be honest with you. Oh, sorry to repeat my question. I thought you're not seeing my cry. Now I'm not sure whether I answered your question. I hope I did. I try and get through the questions one by one, but sometimes it does. Sometimes TikTok just like rolls them forward and I might miss one or two. Yes, Nassif, you're right. You must save. No one will give you a car without interest. So buying a car cash, if you can save up for it, that is always the best thing. What do you think about investing in S&P 500 and MSCI World ETFs over long term? Tatu, I'm going to be very honest with you. It works. Lots of people like doing it. I'm not a big fan of it. So the reason why I'm not a big fan of it, S&P 500 and ETFs is basically passive funds, as they call. So if you invest in the S&P 500, what they basically do is they take all those shares in the S&P 500 and they're going to say it's worth 100 million rand and this share is making up 3% of the S&P 500, this share is 2.9%, this one's 2.8%, and they go invest your money proportionately based on those percentages in those companies. And then tomorrow morning when they wake up and the stock exchange has gone all wild for the day, then they reshuffle it and they say the one that had 3% yesterday is now only 2.8% and the one that was 2.5% is now 2.7%. And then they reshuffle your investment so that you keep on staying and you keep on moving exactly the same way how the S&P 500 is moving. So that's why they call it's called a passive investment. And yes, the S&P 500 does well. But I find that when you make use of actively managed funds, so an actively managed fund is where we actually put the money into a portfolio, where you've got a portfolio manager that invests, ironically, in shares on something like the S&P 500, but that portfolio manager can decide whether he wants to put money into Tesla, or whether he wants to put money into Microsoft, or whether he wants to put money into whatever the case might be. And he can look at the market and say, listen here, I am concerned that Tesla is going to go down the drain. It looks like things are on the horizon, that there is going to be bad growth. So let's move our money out of Tesla and put it into something else. So that portfolio manager, with all the analytics that they have, all the research they have, everything that goes with it, they can be proactive in choosing the shares that they invest with. And for that reason, I like portfolios more than what I like the S&P 500 or ETFs. Make no mistake, there's ETFs and S&P 500s that do very well. They have good returns on investment. I just personally don't like it. So I don't invest my clients' money there. I put my clients' money into portfolios that I've used over the last 25, 30 years, and which has always given good returns on investment, and my clients are happy. And therefore, I just concentrate on those. The other reason why I don't like to do things like ETFs is, like I explained earlier, there are so many portfolios and funds and stuff you can invest in South Africa. It's impossible for anybody to know everything about everything. So if you get to speak to a financial advisor and he says to you, knows all the funds, he's talking nonsense. As a financial advisor, I personally have a small range of funds that I use for my conservative clients, for my medium risk clients, for my high risk clients, and for my very high risk clients. And I concentrate on those portfolios. And yes, I listen to the portfolio managers, I listen to the economists, I concentrate on what they say, I make sure that the funds and the portfolios that I use is in line with what is being said in order to make my determinations. But therefore, I try and keep track of a small range of funds that covers all the people that I could possibly deal with. And because I don't like ETFs and S&P ETFs and things like S&P 500, which are available in the form of funds, I don't recommend them to people. Okay, but it's not to say that it's bad. It's just not my preference. Okay, and let's see. Lit up hat and yeah, I wonder who did that for me. Gave me a hat and moustache here while I'm talking. I have no idea how to do that, but I found that quite funny. Legala, hi. Do you see any unit trust reaching the proposed benchmark? For example, I saw FNB showing a CPI plus 5% in 7 years. Legala, actually, there's a number of unit trusts that hits that. I think one of the big problems that we have is that you must remember that any fund, whether it's a unit trust fund, whether it's a portfolio, whatever the case might be, they get measured on a month-to-month basis. Okay, so let me try and give a small explanation. Let's say you are in a fund that is supposed to give you CPI plus 5%. So at this stage, about 11% return. So in January, you look at that fund and it says the 1 year return is 10%, the 3 year return is 11%, the 5 year return is 9%. Okay? February, they bring in the new figures, and now suddenly January is not, or the 1 year result is not 10% anymore, it's now only 9.5%. The 3 year result is not 11% anymore, it's now 10.8%. The 5 year one is not 8% anymore, it's now 7.8%. When you go into March, it's going to change again. And it's because they measure it from the month of January, 1 year back to the month of January. And then the next year, the next month, they measure it from the month of February to the month of February the previous year. So if January last year, we had a stock exchange that was on a pretty high and everything was doing well, but then February there was a dip in the market, then February's fund fact sheet is going to look worse. And then if March looks even worse, it's going to look worse. But then 5 months later, there's been an upswing, and suddenly somebody shows you these fund fact sheets, and it shows the 1 year return on 13%, and the 3 year return on 14%, etc. It's just because of the time that happened in that market. Now, if people stop worrying about that, the important thing with investment is that you should not be concentrating on those figures. You should be concentrating on the figure that's right at the end of the fund fact sheet, where they say our average return that we have given since the inception of this investment has been 10.8%. If that figure there tells you that they're close, then you know it's a fund that's doing what it's supposed to be doing. But as it is with anybody, we look at the nice figures. We want to see what the investment return is on 1 year and 3 years and 5 years, because I want to be in the best one. The best one is the one that you can see that's been invested for a long period of time, and the return on that long period of time is in line with what that benchmark is. And it is absolutely reachable. I do 2 funds, folks. I do 2 funds which has returns of 14% over 21 years, the one, and the other one return is 16% over 7 years. And they are outperforming CPI by more than the 5%. And once again, if you look at the 1, 3, and 5 year figures, sometimes it's better, sometimes it's worse. But the 21 year and the 7 year returns, the long period returns on those things are showing that they are doing what they're supposed to be doing. My Provident Fund, Rick says, my Provident Fund is at Old Mutual. What do I have to do with the 3 million? With the 3 million, I'm retiring on the 30th of June 2025. So Rick, what you have to do is you're going to have to contact me so that we can sit down and we can go through a lot of different things. I need to know that when you retire now, what income you're going to need. I need to know whether it needs to be guaranteed. I need to know if there's financially dependent people that is going to be reliant on these funds. I need to know if there's debt that you have to pay off. I need to know if you've got another income. I need to know what you need as an income, I need to go and calculate what the tax implication is going to be. I need to go and determine on that 3 million rand, would it be better for you to take 1/3 or not to take 1/3? So there, I know it's easy to ask the question, but the answer is always a long answer because there's so much information that I have to take, feed into a system, do multiple calculations. And only once I've done that, and only once I understand you, because one of the most important things is, we're talking about the figures here, one of the most important things is, I must know you, Rix. I must know if you are conservative, if you are aggressive, if you need to leave money behind, if you need to chase a bigger return than necessary. I need to understand what's going to make you comfortable, and I have to try and marry what your needs are and your personality is with the figures on the other side. And then only can I give you an answer. So Rix, that's my answer. Contact me. You've got my WhatsApp number and you know what my website is. Contact me and we set up an appointment. We do the calculations. I'll make a recommendation. Then you can decide whether you want to take that advice and move forward. Okay. How is best EFT in terms of long term and how much by you estimate? Khanya lady, like I've just explained, I do not concentrate on EFTs, but ETFs, must be ETFs, yeah. So I don't know what the best ETF is. I don't deal in ETFs. I don't like ETFs. I don't look at ETFs. So I cannot tell you what is the best one. And I don't know what the return is that you can expect over a long period of time. If you come and talk to me for advice, we're never going to talk about ETFs. And if you come and talk to me about advice and you insist on having ETFs, I'm going to ask you to please go and find somebody else because I'm not going to be able to help you. Okay. Okay, so where you're asking investments that I can get monthly payments, which ones are the best? If you say you can get monthly payments, I would assume you're talking about getting income on a monthly basis. So there are plenty that you can use. People take money and they put it in the bank, they draw the interest as a monthly income, which I personally don't like, but it's an option. People go and buy a property and get a rental income, and that's possible. I'm not a big fan of that either. You can go and take up a unit trust and draw the growth that you get as an income. That's an option. You can go and buy a guaranteed income plan, as they call it, for a period of time, be it for 5 years, 10 years, 25 years, or the rest of your life. So there are a lot of different investments that you can use for income. Which one is going to be the best for you is going to be basically the same as the explanation I've just given Rix with regards to a 3 million rand. I can only tell you what the best one will be for you when I sit down and I have a consultation with you and I get to understand you and know what your needs are. So here's the one thing that I can tell you. When it comes to pension fund money and liquid money or discretionary money, meaning your own money that you saved, which is not in a pension fund, so let's say your money in the bank, both pension fund monies and money in the bank can be used to buy guaranteed income plans or income plans which are called living annuities or similar to living annuities, where you draw a percentage as an income and where you are on the market with your money still. So here's my opinion about it, is when people talk to me and they do not have enough capital to give them the income that they need, so we're battling to find an income that is going to fit them, then I normally ask those people, or I normally recommend to those people that they buy a guaranteed income plan. And the reason I recommend the guaranteed income plan for somebody that does not have enough capital is you are guaranteed an income for the rest of your life. You know it's not enough, but you're going to have to budget and work on that and get through with it. For people that's got more than enough money, they could go into a living annuity and draw a percentage. And the reason why I'm saying this is for the person that doesn't have enough money and goes into an investment where they draw a percentage, a safe income is 5 to 6%. But then people start drawing 7%, then 8%, then 9%, then 10%. Before they know it, they're drawing 12, 13% of their capital. And before they know it, their capital is finished, it's gone, it's exhausted. So the safe way of looking at it is, if you've got plenty of money or enough money to give you the income that you need, a living annuity can work. If you don't and you are going to be short, a guaranteed income plan is most probably better for you. So that's just my 5 cents on that little one. Mr. Konay, what is a guaranteed income? I hear you mentioned in the video. So, Keegan, a guaranteed income is when you take your capital and you go, there's 2 different ones, the one for pension and one for voluntary money. So let's talk about the one for voluntary money. If you take your R1,000,000 and you go and put it into an income plan, you can say, I want a 10-year guarantee and lifelong thereafter. What that means is that they give you an income, they tell you what your income is going to be, and they guarantee that income for 10 years. If you die inside of those 10 years, so let's say you die in year 3, they still give that income until the end of the 10th year to your beneficiary. So your beneficiary is guaranteed an income for 10 years if you die. If you do not die in the 10 years, you get the income for the rest of your life. Doesn't matter how old you get. Doesn't matter how long. So if you live another 40 years, you get that income for 40 years and then only the income stops. So that is the basic gist of a guaranteed income. You choose a period, they guarantee you your income, they guarantee it for that period, and they guarantee it after that period if you are still surviving. And these incomes you can choose whether it's a level income, whether it must escalate every year. There's 1,000 different combinations that you can go and work on when it comes to these guarantees. I hope it answers it, Keegan. Nalene, sorry, it's suddenly getting very hot here. Hi, I will be retiring in 3 months. How do I invest if I want my kids to collect the balance of my pension fund, is what you're going to say, Nalene. I know that. Nalene, contact me. Come and have a consultation. Come and have a cup of coffee. Let's talk about it. The reason why I'm saying this, Nalene, is I know you want your kids to inherit the money. And the only way for your kids to actually inherit the money is if you do a living annuity. That's where you put your capital away and you start drawing a percentage income. So let's say you draw an income of 6% of your capital, then you're hoping that your investment will grow at 9% so that your capital will remain intact and that you can get an increase into the future. And then if you do pass away, then your kids get that. That's the one way. The other way is to say, I want to buy a capital preservation option. No, not capital preservation, sorry. No, I've slipped my mind. But basically what it comes down to is you can buy a guaranteed income, and then the insurer says to you, okay, your income is going to be 10,000 Rand a month from your pension money, but you want to make sure that this capital is protected. So we're going to give you a life policy on the side, okay, for whatever your capital amount was. But that life policy needs to be paid. So you're going to get 10,000 Rand a month, but we need to pay this life policy. Let's say it's 2 million Rand life cover, which was equal to your pension fund money. So we're going to take 1,000 Rand of your pension money and we're going to pay it towards that life policy. Now you don't get 10,000 Rand a month. Now you only get 9,000 Rand a month, but your capital is protected for your beneficiaries. So those are the 2 ways, living annuity, and really, I can't remember the English for this. But is it the right thing? And that is always the question. Is it the right thing? If you sit and talk to people, it's happened so many times that I've sat down and talked to people and they want to do exactly what you want to do, Nalene. And then when we have this discussion and we go through where your kids are in life, how old they are, for when they need it, do they need it, we come to the realization that a lot of times the fact that you want to leave the capital behind is not what you should be doing. Either your kids don't need it and you should be looking after yourself, or your kids would need an income rather than the actual capital, because if you give them the capital, they're just going to waste it. So I think it's very much, once again, a personal thing, whether it is going to be suitable to you, whether you have a living annuity so that your kids can get the capital, or whether you have a guaranteed type of plan where they can actually get the income into the future. Okay, so let's see. Could my tax-free savings account be my retirement? Yet, yes, your tax-free savings account can be retirement. Any investment can be your retirement. And as a matter of fact, when we talk about retirement, the actual thing is that you should have various investments. You should have a pension fund and maybe a retirement annuity on top of that, and a tax-free plan, and a life endowment policy. And the intention is to have different investments that all together give you a good pension when you go into retirement. But not only that, your pension fund money and the income you're going to get there will be taxable. The money from your tax-free savings account and your endowment is going to be tax-free money. So you will get a bigger income at retirement with a lower tax implication. That's why I always say to people, go and plan these things. Because you might just be shooting yourself in the foot to have everything in your pension fund. And tax-free savings account can be your retirement, but you're going to have a very small retirement because you can only put in 500,000 Rand over the period of time. Now, even today, if you've got 500,000, or even if you've started the tax-free plan years ago and it's standing on R1 million, it's not going to give you a major pension. So it can help towards your retirement, but if it's your only retirement, then you've got a problem. Okay. Pension upon my death. Okay, Nalina, I see you say pension upon your death. I'm not sure whether you mean that your kids needs the pension upon your death. So yeah, maybe you should clarify for me. Is it possible for someone to invest on BlackRock? Some baby, mate, I don't do BlackRock, I don't do Vanguard. I know about BlackRock and Vanguard. I don't deal with those things. Once again, like I say, I deal in the stuff that I am comfortable with and that I have expertise on, knowledge on. And the stuff that I deal in, I am pretty satisfied that although I can't give you a guarantee, I can't tell you, I guarantee you're going to get 5% return on investment, or I guarantee you your capital is safe. I'm not allowed to say that because I'm not the investment house that does the investment. But I can basically guarantee anybody that invests their money with me, they're not going to lose their money and they are not going to get less growth than what I tell them that they're going to grow. So I can basically guarantee that for somebody. I just don't know if it will make anything worthwhile if I put it on a piece of paper. So BlackRock and Vanguard, I know about that stuff, sir. How safe it is, I have no idea. As a matter of fact, just from the rumors I've heard from a couple of investment specialists, I'm not even going to look at that stuff. Okay. Webster, oh, goodness gracious. What happened now? Sorry, Webster, I was just about to read your message and then this thing did this wonderful thing again. Okay, here we go, Webster. If you didn't save enough, can you, after 65, earn a little pension you saved and claimed from? Webster, yes, as a matter of fact, people can. I know there's people that does it. SASSA works on a scale where they say if you have no income, you can claim the maximum of 2,240. But if you have an asset like a small house or you're getting a small income, then we will give you 50% or 25%. So yes, you can. But mate, if you're aiming for retirement at 65 in SASSA, then you seriously need to start reconsidering your goals in life. But yeah, it's just going to be very small. Buy cash and don't want to pay interest, correct? Mr. Yu, is a pension fund better or is a retirement annuity better? It's like asking how long is a piece of string, to be very honest with you. I like a pension fund for the pure and simple reason that if you're working for a company and you've got a pension fund with the company is contributing towards your pension fund. So that means that you are actually getting them to also pay towards your pension fund. Where on a retirement annuity, Remember also pension and provident funds is for people working in companies where they have those funds. Retirement annuities is for people, individuals that don't have pension or provident funds and they have to make provision in their own capacity. So I like the pension fund because the company helps you contribute. But which is better? It actually doesn't determine the actual product does not determine it. It depends on the portfolio inside the product. So if you've got a pension fund and a retirement annuity and both of them are invested in exactly the same portfolio, let's call it the Allan Gray Balance Fund, okay? If you've got a pension fund and a retirement annuity and both of them are in the Allan Gray Balance Fund, you're going to see exactly the same growth on both of them. So it's the fund, which is the portfolio, which is in your fund that makes it good or bad. So if you're with a company that's got a pension fund and the pension fund is doing bad, they're only getting 7% growth, bad luck. Where if you're in a pension fund and they're actually getting 11%, fantastic. And it's the same for the retirement annuity. So it's the underlying portfolio that actually determines which is better, not whether it's a pension or retirement annuity. Hi, Kunai, which market is better on provident fund, high risk, money market, long term, 3 million accumulated so far? So, Kobus, this is my answer to you, sir. If you've got 3 million Rand in your provident fund, okay, and you have to move it now because you're moving from the company. If you've got less than 3 years to retirement, less than 3 years to retirement, I'll look at a medium risk portfolio. If you've got 4 or more years to retirement, I'll look at an aggressive investment. So I will then look at high risk. I will not look at money market. And you say it's long term, so I assume you immediately that we are talking 5 years or longer. So in that case, you want to go high risk. But remember, pension funds, provident funds, retirement annuities, and preservation funds are all regulated by Regulation 28, which means the highest risk you can go is 75% shares. So you must find somebody that can put together a portfolio for you where you've got 75% in shares, and of that 75%, 45% in global shares, and 25% in the cash and the properties, whatever. And if you can get yourself a portfolio like that for the long term, that is where you're going to be the best off, sir. Absolutely. Goeienaand oom, wat weet oom van die derivative investment af? Derivative investment, al wat ek weet is dat dit het te doen met forex markets en koop en verkoop van dollars en yens en wat ook al, maar is al wat ek vir jou kan sê, dit is forex, wat gebruik word in baie portefeuilles tot 'n sekere mate, maar weer eens iets wat ek nie in gebruik maak nie en geen van die maatskappye wat ek mee deel, het uitsluitlike derivative fondse nie. Okay, Filar, is it $1 million after or before tax? Filar, I'm not sure what you're asking here, mate. Is it $1 million after or before tax? I'm lost. I just don't know. Okay, hi there. Ali, if I take 550,000 tax-free, can I take the 148,000 tax concession as well and nothing for a year? Yes. Sorry, Ali, I forgot you asked the question earlier about the 148,000 tax concession. You're talking about the interest again here. Yes. So you can take the 550,000, the 148,000 Rand and live off that. But, here's the big but. Because it's a pension fund or retirement annuity or preservation fund that you are leaving, okay, legislation says that the moment that you choose to take your 1/3 or a portion of your 1/3, you must start taking an income from the 2/3 or the rest of the capital that's left over. So, as much as I'm saying, yes, you can live off the 148 and so basically this makes it 700,000. You can live off that 700,000 for the year. But the rest of your capital that remains behind your pension fund, you have to take an income from it. So the easiest way for you would be to say, okay, I'll put it into a living annuity and I'm going to take the smallest possible income, which is 2.5%. And I have to accept that whatever that is, let's say that 2.5% is 5,000 Rand a month. I'm going to get it. And I'm going to have to pay tax on it if there's tax payable. But if you're going to get 148,000 after we did the tax calculation, Anna, and you're getting 5,000 Rand a month, you're going to end up with about 160,000 Rand taxable income at 18%. So you're going to pay about 20,000 Rand tax for the year. So you're still going to get your 700,000 Rand virtually tax-free, but you are going to be taxed on the pension income. Something interesting to remember for people that do have enough money and can afford to go into a living annuity and take a smaller percentage as an income, living annuities can be converted into guaranteed income plans in the future. But you can't you can't change a guaranteed income plan into a living annuity. So Ali, that might be the route for you to go, is you're going to have to take a small income, and the living annuity might be the answer for you to start off with. Munir, when you say you have investments that can give 14-16%, are these returns before fees? No, it is after fees, Munir. Promise you, China, it's after fees. Next, Keegan. Good evening. What is a guaranteed income? Oh, no, Keegan. No, man. Where were you? I explained this whole thing about 25 minutes ago. Keegan, a guaranteed income is where you take capital, you invest it. I say 10-year guarantee or lifelong thereafter. For the first 10 years, they guarantee your income, whether you are alive or dead. If you do pass away, they give you the income until the end of the 10th year, and then it stops. But if you survive the 10 years, they keep on paying it for the rest of your life. That's the short version. Okay, Keegan. We'll answer this one again next week. I just don't want to do too much of the doubles. MBA, will SARS be able to advise on how much of your tax-free benefit you utilized and how much remain? Yes, indeed they are, MB. When you do your tax returns, I don't do tax returns, okay? So that's the first thing. When you do your tax returns on e-filing, I believe that there is a place on the e-filing where you actually can go and click, and it will actually show you how much you have already saved towards your tax-free plans. So yes, SARS do indeed. What SARS does not do, excuse me, what SARS does not do is SARS does not track your tax-free savings during the year. So if you made a mistake somewhere along the line and you save up 50,000 Rand in different tax-free plans in the year, SARS won't know that until you do your tax returns. And then obviously they will unfortunately tax you. But yes, SARS will be able to tell you. Okay. Mr. C. What is the difference between a retirement annuity fund and a preservation fund? Okay. So a retirement annuity fund, folks, is what you take out in your personal capacity because you don't have a pension or provident fund and you want to save for retirement, or you want to save extra for retirement. Retirement fund, always personal. It's mine. I take it out. A pension or provident fund is done through a company. The company that you work for has a pension or provident fund and you belong to that. Now the preservation fund comes in that if you decide to resign with your company and you are going to work for another company, whatever the case might be, and you need to take that pension or provident fund now, you can either draw the money in cash and then you pay lots of tax, so don't do it, or you can move it to a preservation fund. So that's a preservation fund. That's where you take money from your company pension provident fund and you move it to a preservation fund where they keep this money and they grow this money until you get to retirement, and then you can retire from that preservation fund as you would have retired at your company that you were working at. So preservation fund is one of the best things for anybody that resigns and needs to move their funds, because it's a tax-free move, and in the preservation fund you can now go and make up your own little portfolio like I just explained to Kobus earlier. You can make up your portfolio to suit you best. Okay. So Rick's Old Mutual Provident Fund, 3 million Rand. Great stuff, Rick's. Like I said, you want to come and talk to me? Let's see what you need to do. Passive index funds are just as good as actively managed funds, lower fees and less risk. Just another TikTok user, sir. You know how many times I've had that comment? And part of my friends, but it's bullshit. passive funds, yes, they might be as good as actively managed funds, but it's not that they are lower fees and lower risk. It just ain't. If you go and look at funds, okay, your guaranteed funds, your low risk funds, has the lowest possible cost. And the reason that they have the lowest possible cost is because the portfolio manager does not or cannot play around on the stock exchange to make your money grow faster than 1% above inflation. So the cost is this small. But on a high risk fund or aggressive fund, that portfolio manager needs to get you 5, 7, 8% above inflation. So their management fees is a bit bigger, okay? Because there's more risk and they are under more pressure and they get fired very soon if they don't reach it, okay? But you can get funds in any company from very low risk to very high risk, very low fees to very high fees. And it's going to be the same with your passive index funds. Go and check it out, whether you want to believe me or not. And yes, maybe you have a passive index fund that is high risk and it's 0.5% cheaper than the actively managed fund that the company has. But you know what? I don't care paying an extra 0.5% if the actively managed fund is going to give me 1 or 2% better growth. So, sorry, Mr. TikTok user, sorry to say that, but what you mentioned here is, like I said, just bullshit. Okay, let's see. Ntobang, I just started working. I wish to invest 500 Rand a month and learn more from your videos. Ntobang, you're welcome to contact us. Contact details is in the profile, WhatsApp number, as well as our email, our website where there's an email. Contact us and we will gladly assist you. I've got 11 advisors that works under my wing. All very educated. I check them, so they must be compliant with how I train people, how I give advice. So you're welcome to contact us, and I have somebody that will be able to help you. As a beginning investor, what would you advise one to invest into? How to choose the right stock? Mtura, I don't do stock trading, mate. I don't do shares. So I can't advise you there. You want to do stocks and shares? You either do it yourself via one of these easy equities or a bank app where you can buy shares through them. Or you find yourself a stockbroker. Then you're going to need a lot more money because they do charge a pretty penny. As a beginning investor, what I can tell you to do is start an emergency fund. So make sure you've got some money in the bank for emergencies. That's very, very important. And then from there, depending on how much you earn, there is going to be a decision to be made whether it's going to be a retirement annuity, a unit trust, or an endowment. And the tax has a big implication. And also for when you are saving. Are you saving for retirement or are you saving for something you want to buy in 5 or 10 years' time? So once again, you're going to have to speak to somebody that can guide you with some financial advice. Like I just said to Ntobang, contact us. We'll help you out. Pick your program. Hello, I just joined now and I have a lot of money. I don't want to leave cash for my family. What can I do? Pick your program. And I'm going to tell you exactly the same as the previous two guys. You're going to have to make an appointment with somebody like myself, a financial advisor that you trust, okay? And you're going to have to speak to a financial advisor that can guide you with regards to what you need to do with your money. Because I can tell you I've got a lot of money, but I've only got 500,000 Rand. For somebody else, a lot of money is 50 million Rand. For somebody else, a lot of money is 500 million Rand. A lot of money means different things to different people. And what you need to do with your money is going to depend on your personal circumstances, what you need as an income, whether you want to give money away, whether you want to go on lots of holidays, how long the money is. There's a lot of questions. It's not easy to just tell somebody what to do. If it was this easy, if it was this easy to give an answer to somebody in one sentence and then to earn an income, man, I should have been a multimillionaire. But unfortunately, I have to do a lot of work. When people consult with me, remember, I've been doing this for 30 years. So I've got quite a bit of knowledge. I've got quite a bit of experience. But if I consult with anybody, except for the hour I consult with you, it takes me at least another hour to get all the information and to do the analysis and to type up a report for you. And then it takes me another 45 minutes to an hour to give you feedback. It's 3 hours work, and then I'm not even guaranteed that you're going to invest the money with me. But that's what I'm trying to say. It's not as easy as giving you an answer in 30 seconds. So contact me. Let's set up a meeting and then we'll take it from there. Okay. My consultation rates, Keegan. I'm way too cheap, I must be honest. But I ask a consultation fee of 1,000 Rand for the first appointment. And after that first appointment, any further fees or commissions or anything payable, I discuss with the client and we decide together what it's going to be. But yeah, 1,000 Rand for a consultation, mate. Where are your offices located? How much is your consultation fee? BBM. My offices are in Krugersdorp, and I do ask a consultation fee of 1,000 Rand. But I do have advisors in Cape Town, Potchefstroom, and the East Rand. So I do have a few people across the country. Keegan, if you want to buy a guaranteed income, you're going to have to pay that grand and come and see me, mate. I'm just joking, but yeah, sorry, mate. I can't tell you. I've explained that 3 times tonight. I'm turning 57 years old. How about I resign at 59? E, are you nuts, sir? Seriously. I don't want to be disrespectful to anybody. But I have made so many videos and said on so many occasions, you don't want to resign and withdraw your money. Because if you resign, you withdraw your money, you pay a hell of a lot of tax. You lose a lot of money. So if you want to do anything at the age of 59, you retire from your fund. But you don't resign. If you resign, obviously you're going to resign because you're leaving the company. But I mean, you don't resign from the fund. You retire from the fund. The one thing, folks, that people don't understand is so many people say, I want that money because I can go and do something with it. If you are a mature person, I don't care, anything from the age of 45 and older, and you have not been very successful financially in your life. When I say not very successful, you are not wealthy, you are not rich. Okay? What makes you think that now suddenly you're going to take your money and you are going to be super efficient, disciplined, and know exactly what to do and make a hell of a lot of money? It's simple. Use what you have, but don't shoot yourself in the foot. I hope I have not disrespected you now, but hopefully I haven't. My offices, BBM, is in Krugersdorp, and the consultation fee is 1,000 Rand. France, I want to steer my TFSA myself. Would you recommend Signia or Easy Equities? France, personally, I'll go with Signia. That's my opinion. Nothing wrong with Easy Equities, but if it was my money, I'll go with Signia. Oh, are there any books that you recommend about the valuable information? Oh, there is so many. But I think one of the most important books that you can go and read is a book that teaches you with nice stories about how to become wealthy. The Richest Man in Babylon. So go and do that one. Sorry, I don't have the other book with me. The Psychology of Money. That is the other one. If you do read those 2 books, The Psychology of Money and The Richest Man in Babylon, and you buy into it and you actually follow those things, you are already miles ahead. And then just about anything by David Ramsey. David Ramsey and his Baby Steps book, and absolutely go and read that. It's going to be the best. Folks, I see we are way past 7 o'clock, so I'm going to try and answer one or two more, and then I'm going to switch off and go and say, I'm sorry, I can't answer everybody. Okay, let's see. One or two. How much does the bank for 1 million rand for a month? Lionel, I don't know what you're asking. I don't know if you're asking how much does the bank give you for 1 million rand for a month, but you're going to have to find out from the bank, mate. I'm not a bank. I don't deal with banks. Invest for short-term goal versus long-term goal. Very true. Learn this with Unit Trust. Great. I'm glad about that. Candace, hi there. Sorry, if this is unrelated, please advise on how to effectively get out of debt. Candace, so the first thing is to get out of debt is you need to learn how to work with your money discipline. You need to work on a budget. Most people I've ever spoken to about debt has never worked on a budget. So that's the first thing. You're going to have to work on a budget, and you have to going to be disciplined with your money. The second thing that you can do is you go and write down all your debts, okay, from the smallest to the biggest debt, as well as the interest rate so you can see it. Then you go and pay the absolute minimum on all of your debts, except for the smallest one. The smallest one, you pay what you need to pay, plus anything extra you can pay there. And you pay that smallest debt off. And once you've paid that smallest debt off, then you go to the second smallest debt. You do the same thing. You pay the smallest amount on every one of your creditors, but the second smallest debt, you now put all the money that you have to pay there, plus all the money that you paid on your smallest debt, plus everything extra that you have. And you kill that debt. And once you finish with that one, you do the third and the fourth and the fifth and the sixth and the sixth. And that is how you get out of debt. And then once you have paid off your last debt, because it will go faster and faster and faster and faster and faster. And once you pay off your last debt, okay, then all the money that you've been paying on debt on a monthly basis, you are used to spending. And that's when you take that money and you start saving it. And that is when you become really wealthy. Okay, Candace, I hope it helps. No, Mfuru, I don't do debt review, but like I can give a bit of advice, but I don't do debt review. As a matter of fact, I'm not a big fan of debt review. I believe that people who really discipline themselves, works on a budget, and follow these simple steps that I've just explained to Candace, can get themselves out of debt themselves. How to retire from the fund? You must get forms that you need to complete to tell them what you're going to do with your money, and then you have to obviously complete other forms as to where the money must go for the income that you're going to get. You're going to need to speak to a financial advisor. You can't do it on your own. Folks, that's it. I'm going to have to say goodnight to you. Otherwise, I'm going to sit you all night. And I really want to catch on a bit of R&R and sleep. Until next week, Wednesday, have a great time. You can all contact me via the WhatsApp number in my profile or the email address on our website. And either myself or one of my advisors can assist you with some advice, consultations, any help you need. Okay. All of the best. Keep well. Bye-bye.